I'm
Yeah.
Evan Baldridge. I'm the COO of Better Bookkeeping. Mitchell's our co-founder. Mitchell, why don't you introduce yourself?
Yeah. Mitchell Baldridge, CPA, financial planner. I run a accounting firm in Houston, Texas, and we run better bookkeeping for solopreneurs and solo founders to help people keep their books organized and save on taxes.
And today we're really focused on, and if you've come to any of our presentations before or seen anything online, we kind of go through the run of the gamut for small business owners. This focus is really around kind of the small business owner. But today we're really wanting to just, given that it's December 11th, you got 20 days left, like what do you need to do? If there's anything you can do, what would that look like? So that's our plan is just to focus on some of those key levers. And maybe you're doing all of them, which is excellent. I always like to say this when I'm talking to prospects, like we at Better Bookkeeping and Mitchell in general, like we don't pull rabbits out of our hats. We are following the things that are available to you guys just as out in the world. And so what are the things that are at your fingertips that you may not know about? And that's really what today is about, is just making sure we can walk through all those things. And we will be
It's
putting on a recording of this for anyone who's attending, or even if you didn't attend, hello. Here's the recording for you, so you can watch it back. So that just so everyone knows, because I that's the question we usually get the most is, am I going to get a copy of this recording? The answer is yes. The other piece of information is there is a Q&A button. And if you want to ask any questions throughout, Derek, who is our CPA at Better Bookkeeping, will be helping to moderate those throughout the call. We may bring some of those to the chat if they are good for the wider audience. And then, of course, you can always reach out to me or Mitchell after this for for more one-on-one help and advice. Better Bookkeeping is taking on new clients, so that's my spiel.
all right. Let's get started. So yeah, we're definitely into the crunch time of the year. One of the most kind of popular threads I've ever posted, or the most popular emails I've ever, or the most kind of something that's landed with people is when I say, every February a bunch of clients come on, they hire us to do their taxes and to get them organized and to catch them up, and we walk them through all these strategies and all these savings and all these opportunities. We put it all into place, and they go, "Great! I'm saving $50,000 this year." Well, can you go back and fix last year? Furthermore, can we amend the last 3 years? And the answer is like, no, we can't. We can fix you up going forward, but you're too late. So it's the conversation I have in February that I always wish I had in November. Well, here we are, December 11th. Not as good as November, but better late than never. And so we're going to do whatever we can to get you set up for this year. So, this is the caution, keep clear, explosive powered tool in use. This is the kind of my lawyer made me write it slide. I am a CPA. I am a financial planner. We're an accounting firm. We're not your CPA, nor are we your financial planner. And even if we are, this is intended to be general advice. We're moving around big, heavy things. We're doing big work. And if you don't think this all the way through, you might hurt yourself. My 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 wife's aunt called me the other day for some tax advice, and she said she's a therapist by background and has a bunch of rental property. And she said, "Well, we do our own taxes in TurboTax." And I said, "Well, I do my own therapy, so we're great." So
Actually, love that.
yeah, it is what it is. I get what I pay for with my therapeutic practice. Um, so 20 days left. What's still possible? This is your last chance. Again, you may not be able to push it all in. One thing worth noting is that we are still taking on clients. We're taking on year-end clients, but we're probably going to take on about five. I mean, it's really, we don't want to work that week of Christmas to New Year. We don't want to be setting up your payroll on December 28th. It's really stressful and a really kind of like difficult time of the year. And frankly, we just want to do a really, really good job and have a pretty chill practice. Yeah, or we don't want to be stressing and doing things at the last minute. So, but this information is so valuable and can save a lot of people a lot. So we want to get it out there, and we want to take on a few clients, but I just want an expectation set right there. But the reality is that the kind of standard playbook we run for our clients who are these self-employed, solopreneur, entrepreneur, small business type people is that when folks come in and they're completely unoptimized and we get to optimize them, they save a ton of time and a ton of money and get their life in order. So, if you're a 1099 type contractor type small business owner and you are completely unstructured, we can save you 10 to 25 to $50,000 of tax in 20 days if you've done nothing and you're making, 400, $500,000. And so, yeah, and then if we get to January 1st, there are just levers we can't pull because we didn't think, or it's just too late. So the questions that we're going to talk about today: do I have the right entity structure? Am I paying myself the right salary? Have I bought everything I possibly can? Should I buy something? Should I not buy something? Have I set up a retirement plan? Have I done everything I can do there? And, am I squared away? And yeah, are my books right? Am I clean? Am I organized? Do I even know how to answer the first four questions? So, we have 53 minutes and then we have 20 days. So let's go.
So the focus is really, like I said at the very beginning, and I know I've had a few people join, the focus is really going to be like we talk about entity structure during a lot of our webinars. We talk about salary optimization. We talk about these different retirement, and of course bookkeeping. But what we're really going to try to do is hone in on what are the things you could potentially lever and do now. So for you guys who are out there and someone was asking about if you already have an accountant, what can I ask them? These are the things. Like, is my salary optimized? What else should I buy? Like and we'll go through this as we talk through these different areas. My favorite is when people call me, well, it's not my favorite because it means they've been under
It's your
optimized.
least favorite.
It's
Oh,
my
yeah.
least favorite because when I get a call from someone who says, started my own business a couple years ago or last year, I don't know what I'm doing. My books are a mess. Like that's what most people are embarrassed and they're like, you've never seen books as bad as mine. And I'm like, of course I have. Like I've seen worse, I promise. Um, but making them an S corp is always the like golden ticket. 9 times out of 10, 99 times out of 100. It's going to be the thing that's going to really help them the most. And really this entity structure and making sure that you have the right thing in place. That's a big thing that there's still time on, and this is also a huge place that you can save money, especially from that sole prop LLC moving into an S corp.
Yeah, this is just realistically, this is also the question of do I need an LLC? Because you can set up an LLC on December 11th for 2025, and you can kind of nominally distribute a lot of the activity into the LLC and just kind of catch up the year. It's not great, but you can do it. What you can't do is set up an LLC in February 2026 and elect retroactive S corp status and get to work for 2025. It's just the ship sailed. It's over. So if you're going to set up even if you come to us in February and you have the single member LLC, we can sometimes do the late S corp election, but we'll talk about salary. Can't do that. So, but the LLC is one of those things where if you're not set up at in 2025, too late. So, yeah, a lot of the most common structures we walk into are someone just walks up and they say, you'll see crazy examples of, hey, I make $3 million a year and it's just in my name and I don't have an LLC. I don't have anything going. I just file a Schedule C and here we go. Well, that sounds like the cash register ringing to us because ultimately those people are horribly under optimized.
Mitchell, you just cut out from a, I don't know what happened to you. But what Mitchell was saying is that
Yeah.
people who, there you go. Go ahead.
Oh, well, so they're not getting the qualified business income deduction that was available to them on the high end, or on the low end, they're just paying self-employment tax on every single dollar that they earn when they could be paying themselves a reasonable salary and passing through distributions that don't get hit with self-employment tax. We'll talk more about salary. But so, at a minimum, and they don't have, I'm not a lawyer, but, LLCs offer certain liability protections. They offer certain benefits. And, if you can get the LLC, I think you got to scoot back, Evan. And then, if you can get the LLC that's out there and you can, let's talk about the S corp thing now. So now when folks come to us, and whether they don't have an LLC or have an LLC, we start to look at, well, so an LLC can be a lot of things in the tax world. It can just kind of sit there and be disregarded. So it's almost like there's not an LLC at all. You just pay the taxes personally. Or you can elect to be a partnership, but you have to have more than one partner, or S corp, or a C corp. And really, what we deal with mostly at Better Bookkeeping is, small business owners or solo founders who have S corps because they have kind of consulting income, or that type of kind of 1099 income, or a select number of our clients are C corps because they want to go do qualified small business stock out there because they've raised venture capital. So this structure of Tom comes to us and he's made $400,000 for the year and he's spent 40 and he's netted 360. And if he does nothing, he's going to pay self-employment tax on every single dollar of the 400K. So he's going to pay 15.3% all the way up to 180. Then he's going to pay the additional Medicare tax on every dollar up to 160 from there, on the other 160 that's out there today. And then he's going to be limited on the qualified business income deduction, especially if he has a spouse and if they earn above the QBI limitations. And he's going to have limited options as to what he can do with retirement planning and certain things like that without an LLC or without any planning. So Tom, if he's a solo consultant, we're going to extremely encourage him to go get an S corp that's out there. And when would we start to do that? If he came in and said, "Hey, I grossed $100,000 this year, and I know I'm going to grow every year, and I know I'm going to this is my new path," I would say, "Hey, you can go on to Better Legal and set up an LLC for less than $1,000. Let's get to work." And so, immediately he would be able to pay himself a salary. Like in this example, the salary is $150,000. Like that's frankly pretty high. Or it depends. So the salary you pay yourself is theoretically like what you would pay somebody else to do your job. So like if a therapist comes on board and they're in private practice and they're out billing $150, $200 an hour, grossing $400,000. I mean, we see that. Well, therapists in kind of public practice, or in early, or in these kind of like salon models, they make $75,000, $100,000 a year. That becomes a pretty clear baseline salary for what they get paid. You can go on to the Bureau of Labor Statistics and go try to research what your appropriate salary would be, or you can kind of run it as a business model. You generally wind up at 25 to 30%, let's just
Where
say.
And Mitchell, we're about to go through salary optimization on the next slide.
Sorry.
So,
Ultimately, Tom picked his salary. He picked 150. So he made 400, he spent 40, he netted 360, his salary is 150, and his distributions are 210. Because he went through that rigmarole of setting up the S corp and paying himself the salary, it effectively just saves him $30,000, which is a pretty wild deal because he filed some paperwork and chose to pay himself a salary. But what happened was he paid a little bit less self-employment tax because he got capped at 150 and he didn't go all the way to 180 and then ultimately to 360. And he was able to optimize his qualified business income and go get a ultimately, you take 360 minus 150 is 210. He got another $42,000 deduction that's out there because he optimized for qualified business income and it didn't become limited. Now, qualified business income isn't available to certain types of businesses. It's not available to doctors and lawyers and accountants, unfortunately, and famous people and actors and a lot of people who work on their own skill set. So certain consultants wouldn't be eligible for QBI. They would be a specialty service trade business, but we take care of a lot of that and we help consult through that with clients.
yeah, I think Mitchell mentioned earlier that he was talking about if the $100,000 it becomes worth it. Like we usually say anywhere around like 70 net profit. So how much money hits your bank account is usually about where the juice becomes worth the squeeze. Because I do like to talk about that having an S corp requires the PITA tax because it is a pain. You have to go set up a payroll. You got to do more things. Like there's definitely more involvement. When you have an S corp, you have to file a separate tax return. But the savings are very real, and it's definitely something to consider if you haven't already. For if you're
This
able.
morning I was on Twitter talking to the great strip mall guy, and he said he was firing paychecks. And we use Gusto as a payroll provider generally, and I've used them for like 10 years. They're not paying me to say this, but ultimately it's a pretty it's 40, $50 a month to pay yourself, and it's a pretty intuitive software, and it just works. So it's a fintech kind of web 2.0 forward software. You don't have to call the payroll agent to run payroll. So it's millennial friendly. Um, so yeah, I jumped the gun and talked some about salary optimization, but again, salary is one of those things. Got to fix it in 2025. It's got to be paid by December 31st. If you try to run it in January, you get jammed up with all these late payments and penalties because you have to remit all the payroll taxes. The government gets very, very, very angry if you don't turn over payroll taxes immediately. That's their money, and you know people go to jail, frankly, for in big companies for taking all the payroll taxes and never sending them off and just buying a ski boat or whatever. You can get big trouble for that. So again, someone like Gusto, they just debit it all, they send it off for you, and you're none the wiser. It just gets taken care of. Um, So yeah, the way you pick your salary generally, again, like I mentioned, you go to the Bureau of Labor Statistics, you find the appropriate salary, you decide what you would pay someone to do your job and all your job functions, and that's the right salary. Well, really, when you're low income, meaning you're not trying to optimize for QBI for the qualified business income deduction that's out there today, which we'll talk about in the two-step optimization process, you're really trying to kind of like play poor. You want to have your salary as low as possible because that's your advantage because you'll pay as little payroll taxes on it and you'll save money there. Now then when you break through and you go through the threshold where you have to optimize for QBI, especially if you're not a specialty service trade business, then you want to follow this 2/7 rule. You take your business income, uh, add back all the salaries that have been paid, multiply that number by 28%, and then subtract all the salaries that have been paid if you have other employees. And that's kind of your salary at a minimum, because you need to pay yourself that, because that's how you optimize the QBI deduction out there. So, kind of the strategy that we do with folks is we just do this nominal salary. Let's say you think you're going to wind up at 200. Well, we're just like, we're going to pay you 100, or we're going to pay you 125 all year long. And then at the end of the year, we kind of calculate that bonus, we sharpen the pencil, and then we run a payroll bonus. And you can do a few things with that payroll bonus. One, you can optimize QBI down to the nickel, hopefully. And two, you can decide how much of that bonus you want to withhold and send directly to the government as federal income tax withholding. A cool trick is kind of like, they take that last payment and start to apply it as though you withheld it pro rata through 365 days of the year. So if you're behind on paying some of your quarterlies, you can get a little bit of a absolution that way, and stay out of trouble. So
This is yeah, so this is what we're doing right now. This is why Better Bookkeeping is busy because
yeah,
we are going in and looking at everyone's end of year real dollars and everything earned. And we have our clients pay a lower, we hope to have them pay a little bit of a lower salary. You can't claw back payroll tax. So, the Goldilocks number throughout the year may change by the end of the year, but we're looking at trying to make sure we're optimizing for that QBI number if we need to. We're going in and trying to use withholding, especially for newer clients who've not been paying quarterly or haven't been paying a salary this year. The biggest thing we do at the end of the year is say, hey, go ahead and make a payment to the IRS through your new salary through Gusto. They're really excellent at this. We give that number, for what the safe harbor amount is, which we can talk about in just a second, but we run that payroll with those withholdings, and then the IRS isn't coming back and saying, oh, well, you didn't pay Q1, Q2, Q3. And they're not charging you that penalty and interest from underpayment throughout the year. So if you have a CPA out there already and you haven't been doing any of these things, this is a place that you can almost play catch up. This is where you can catch up with the rest of the folks who are being good model tax-paying citizens for their businesses and everything like that. Like this is where you can kind of skip the line.
yeah. And we've earned a bunch of client business in our time by just looking at high income earners who, you look at this form 8995 and you see, has there been a limitation because they didn't pay themselves enough salary, frankly, and you fix the salary and you tell them they would have saved 32 grand if they had fixed it last year, and there you go. You've paid for 3 years of fees off the bat, so life's good.
And
um,
and given that there's only a handful of days left in the year, if you don't fully have all your books ready to go and everything isn't golden, the thing you can at least do is find out what your safe harbor amount is. And we have some on here, there's the simple calculation. So the safe harbor amount is essentially one of three things, depending on how much money you make. Um, Either pay 100% of last year if you made less than 150,000, or if AGI was less than 150, 110 of last year if it was over 150. And then if you're having a lower year, you can pay 90% of the current year. That does require you to have your books in a row. Um,
so ultimately, if my total tax last year was $100,000 and I won the lottery on July 4th this year, and got the $1 billion Powerball, all I would need to have paid in by January 15th is $110,000. And then by April 15th of 2026, I got to have the 100% of my total tax, or most of my total tax, paid in. And so for people who have rapidly growing businesses, they can stay up to speed by just paying 110% of last year, but they need to ultimately know what they're going to need to pay in April, because April also gets you, because you have to catch up. pay the remainder of your 2025 taxes in April, and then you have to pay your first quarterly payment for next year. So you gotta. That's one thing that we really work to help our clients with is cash flow forecasting what their taxes are going to be, so that there's no surprises. Nobody likes surprises when you're cutting money to the government, even though they do a great job with it. Um, so
All right, we're going to move into the buying. Have you bought everything you can? And and
big,
the bigger question is, should you? Like, this is my favorite when I talk to people. I'm like, do you need that? If you do,
good, yeah, you're all going to get a free G wagon at the end of this call. No, not really.
no.
So ultimately, yeah, that I one of my favorite tweets, and this is like a half true story, but I'm like standing in this prospect's office, and he has 3 trucks parked behind his office, and they're like 3 pickup trucks. And the joke is, walk into prospect's office, there's 7 pristine pickup trucks. We're staring out the window. He says, I can't even stop buying them, wouldn't even know how. But ultimately people get caught up in this thing where they're like, oh, I need to buy a pickup truck to save on taxes, which is a ridiculous idea. I mean, first of all, if you spend $1, at the most you're going to save 37 cents. So 50K of equipment is, which a pickup truck costs more than $50,000 now. A $50,000 truck at the top tax bracket is going to save you $18,000. So if you have a lot of income this year and you need a truck, go buy a truck. But it's not a free truck. It's a $31,500 truck. And the reason people like trucks is because you can go put $1,000 down at the dealership and they'll let you walk out with a truck. And so it feels like this big, oh, I put $1,000 down and I saved $18,000. But ultimately, you bought something for $50,000 that's going to be worth like 15 grand when you go sell it in 5 years and roll the whole thing over, and that you're going to be stuck making payments on for a long time. So what you can buy at the end of the year is you can buy supplies, you can pay vendors, you can buy equipment, you can buy 6,000 pound plus business vehicles, you can improve your property, you can go kind of make investments and try to write out checks and try to shove a lot of spending into December to save on taxes. Well, why would you do this? Because you need what you're about to buy, because you're in a relatively high tax bracket, and because you have the cash, and you're going to have the cash in April and January to pay your taxes as well. So you don't want to like eat all of your seed corn in December because you wanted to save on tax. And then when you look up, you realize that you paid 100 grand to save 30 grand a bunch of times, and now you don't have the money to pay your taxes. That would be a foolish thing to do. So ultimately, playing this game, unless you're going to go borrow money to buy pickup trucks, is generally a cash intensive thing to do. And this is a smart thing to do if you need to go spend money on your business and you think you're in a high tax bracket year. The reason not to do this is because you don't need what you're buying, because you don't have the cash to do it, or because you're in like the 22% tax bracket this year and you're going to be in the 37% tax bracket next year, right?
Mitchell, why don't you give like a 45-second, what is 179 versus bonus depreciation?
So bonus depreciation's back. On July 4th, they signed the One Big Beautiful Bill. So as of January 20th, if you bought something on the 21st or forward, it qualifies for 100% bonus. That is business property, including 6,000 pound plus trucks. Like, all cars would be business property, but they made a special provision for cars, passenger vehicles less than 6,000 pounds. So a forklift less than 6,000 pounds is still business property, and passenger vehicles above 6,000 pounds are. But so ultimately, bonus is much more useful today because it's back to 100%. And the thing that you can do with bonus that you can't really do with 179 is you can create losses. So with section 179, you're limited as to how much you can place into service and how much total how much 179 can you take, how much total equipment did you place in service that year. There's limitations, and it can only drive your income to zero, whereas bonus can drive you to less than zero. So in the new kind of while there's permanent 100% bonus, people are going to mostly just do bonus depreciation. I mean, this all comes back to this principle of like, if I buy a stapler or if I buy a $300 computer monitor, like these are immaterial, kind of below $2,500. You can just write them off. They're supplies. They're just like business expenses. Whereas when you buy something like a truck for $50,000, they require you to capitalize it and deduct it over time. So to spur the economy and for reasons, and because the president likes real estate and a lot of things, they brought back bonus depreciation, which just allows you to take 5, 7, 15 year this kind of personal property and deduct it day one. So again, don't make panic purchases to save on taxes. Do make smart buying decisions that'll save you today. Um, should you buy it, the wrong reason, I need to save taxes, the right reason, this is a great investment. I was going to buy this stuff next year anyway. Let me push it forward so that I can, you know, defer some taxes a little bit quicker, get some time value of money, and, you know, get what I need. Other thing worth noting, you need to have it in service on December 31st. So if you order equipment and it's got a long lead time, you may not be may not be able to do it. Real estate, you're probably not going to go find,
Yeah.
put under contract, close in 20 days, and even then, if you're going to go buy some real estate and try to get savings, so that's a whole other webinar. But DM me.
Mitchell, quick question from the audience. Is there a personal use limit on qualified bonus depreciation property?
Yeah, I mean, really, the first year, like if you're going to buy a truck on December 12th, I would try to use it as much as you can for bonus the first year, and really as much as you can for bonus thereafter. When you dip below 50%, weird things start happening and it flips. So, do not buy a truck and use it for business for 18 days and then hand it off to your daughter the first of the year. Like that's not going to fly, you
But just
know?
in general, like what is the rule? I think you need to use it for at least 50% of business for it to be considered business.
Yeah, and like if you have a truck, it's not all or nothing. So like generally, if you put the truck that sits in your driveway, if you bought it and wanted to bonus depreciate it, I wouldn't tell you to depreciate it more than 80% of it, or maybe even 60% of it, depending on how you use it. Ultimately, you can keep a mileage log, you know, but yeah, there's a reality of just how much of it is business and how much of it is personal. But man, you know, business is the best tax deal in America because if you're not in business, you get none of it. So yeah, there's the idea of accelerating expenses. I got a note yesterday from a consultant I work with, and he said, "Hey, if you want to pay your next your next year's fee this year, let it rip. I'm taking money." And so we are too at Better Bookkeeping. If you want to pay us, we'll just drop a Stripe link at the bottom. But like ultimately, to the sin, if you're an accrual basis taxpayer, then a lot of this goes out the window. But 99% of our clients are cash basis. And so if you can justifiably get the money out the door, and shoot, maybe your vendor will give you a discount, or maybe, maybe your vendor will take the money. They usually will. You can get a lot of expenses out of the way. It's a really good idea if you have an especially high tax year. If you know you're in the 37% tax bracket and that you're going to be 32 next year, get some expenses out the door.
Yeah, I mean, one of the things that I do spend a lot of time talking to our clients about is like, and because pretty much everyone who's joining us is thinking and does is on the rise. They're trying to do better year over year. And so my devil's advocate is always, do you want to go spend all this money today? Because if next year you make 30% more, having these expenses available in your back pocket, or, maybe not
You just
completely
get
one.
on it. Oh, sorry. You get on a treadmill. You know what I mean? Like you get to paying everybody, and people do this with their property taxes commonly. You can pay them in December or January. You can double pay them in one year, but if you start paying in December, you just become a December person. Otherwise, you're going to go a year and pay nothing.
Yeah,
So
but we have a client who's on the bubble between different, there's a there where they are an SS, they won't qualify for QBI if they pass a certain threshold. And so we have been talking to them about how to keep their income under a certain threshold and go buy as many things as they can, defer revenue until next year, because next year there's no doubt they're going to be over that threshold. So next year
well,
won't matter. Go ahead and just get it taken care of this year. But these are more edge cases, and it doesn't always, um, that's where I don't see it a lot with our clients, but it's definitely something where if you're on a bubble, there's things you can do, defer or accelerate your expenses. Those are just tools you have in your pocket. Now you're running out of time through the end of the year, but definitely things to keep an eye out, especially as you're trying to maximize QBI and tax savings at the end of the year.
huge rule around like tax planning is just like you have to think uh, 14 months ahead, or if you're going to buy a truck, you got to think about when you're going to sell the truck. Or now about to talk about retirement. Like you have to think about when you defer the tax and when you're going to pick up the tax. So let's talk about retirement, and let's throw a little let's tie these two things together, which is like our client who's on the bubble. We're going to talk to them next year about retirement planning and setting up. I'm about to trash retirement and call the whole thing a scam because for about 10 minutes. But that person, if they can go start saving for retirement and manufacture a pretty big expense that's going to keep them in the QBI range, these retirement contributions can become like a 2-to-1 thing. So
Just these
that
levers, like these are just levers you have in your pocket, and they're just things to keep aware of. And back to the
yeah,
person at the beginning of the call who asked, "What should you ask your CPA?" These are the questions. Like,
yeah.
am I
What
where
can
am
I
I?
do?
Yeah, where am I?
Yeah. Where am I? What can I
And
do?
if you're a better if you're a better bookkeeping client, we're already looking at these questions for you. I had an email this morning. It was like, "Hey, are we doing these things?" And it's like, "Yes, this is what we're not having to squeeze it all in at the end of the year because we've been doing it all year." But it's definitely, there's always things to keep considering and, keep on your toes with.
So retirement planning, when you own your own business, you get this opportunity to go start to think about how you're going to establish a retirement. Well, first of all, the pension's dead. The gold watch at the end of 50 years is dead. Like you're on your own, and you have to now be responsible for this. Especially like one disadvantage of lowering your salary, back to the salary conversation, is like when you don't pay as much self-employment tax, your social security credits might be different at the end of your career. If you paid yourself 50 grand for 20 years instead of paying yourself 130 grand or 180, like uh, I promise, if you take the amount you saved on self-employment taxes and go invest them in the market, you will come out ahead versus if you have the government saving for you. But like you are now responsible for this. So like if you're a solopreneur or a small business owner or have a couple of partners, like retirement planning can be a huge opportunity and a huge boondoggle. Once you start getting a bunch of employees, the kind of like potential goes down because any kind of matching or sharing or big Cadillac insurance plans, retirement plans, et cetera, that you give to yourself, these like cafeteria plans is what they call them. You have to bring them out to the entire employment base. Like they don't want the doctors on one plan and the nurses on the other. Executives can't have one thing and then line employees have another. So if you're a solo person, you must set up a solo 401k by December 31st. You can go to Vanguard or Charles Schwab or Fidelity, or you can go to Carry, or you can go to
Pick
some
one.
of these kind of like, yeah, and internet forward ones. But like you can go set up a Charles Schwab 401k. You could probably do it tomorrow and have it done by the end of next week. And then you have to have your employee deferral done by December 31st because we're talking about the end of the year here. So that has to pass through your payroll and it has to be organized with Gusto that you're setting up. Like if you're trying to get an LLC S corp set up, pay yourself salary and get your retirement planning done and you want us to help you, yeah, you need to talk to us tomorrow. So, there's just an order of things that have to happen for I was talking about it with a client. Like uh, Christmas dinner is at noon, and we need to be ready to say the prayer at 11:55. And so, what all has to happen for all the food to be on the table and everyone to be standing around? And we're in that kind of thing where it can take 2 weeks to make all this stuff happen, and Christmas is 2 weeks from today. So let's get to work. But ultimately, this retirement planning is a huge opportunity. Um, you can do the solo 401k, you can do a simple IRA, you can do a full fledged 401k. These are the reason why you do things is depending if it's just you or if you have employees, depending on how much you want to save. High earners will do their own defined benefit plan uh, for them or them and their spouse. You can do a SEP IRA. One benefit of a SEP IRA is you probably can set that up next year. So ultimately, like depending on where we are and where you are, we decide there's a whole decision tree that goes into kind of what retirement plan you would set up, depending on how much you want to save, how big your company is, when you plan to hire employees, all of that. But ultimately, this is a pretty nuanced decision tree, and if you want to start saving, it's time to get to work. And again, this can be one of those tools where, like, so yeah, I wrote the email today about tax smart retirement planning effectively. Like everyone talks about asset diversification. No one would tell you, hey, you're 68 years old, you should be 100% in the S&P. They say you should have bonds and cash and stocks and a broad, diverse global portfolio. Well, the same thing is with tax. Like I've seen many times people wake up and you think you won the game because you have like $4 million in your retirement plan. And then they're 73 and they start getting into minimum distributions. And it's like 350 grand a year that they have to start taking out every year. And they're like they're an old single guy who is now paying 35% tax on their retirement that they started saving when they were like 23 at like a 15% tax rate. So you think about when you contribute the money that you're going to save this tax, but you're really deferring it and you're going to pay it one day or your kids are going to pay it. And so the idea of having some Roth and some ordinary retirement and just some taxable brokerage, these are the three buckets. This is how you need to kind of balance everything. On the fallow years, you could take, you know, or low income years, you can take your retirement plan and convert it to a Roth. You know, high income tax years, when you're in the 37% bracket and you're just crushing it, you can go do a defined benefit plan or go do a kind of ordinary IRA. But you just don't want to be socking money away with less than a 24% marginal savings to go to the end of your life and die, and your kids have to deal with it at 37%. A big thing that happened with the Secure Act is that they now only give you 10 years to liquidate an inherited IRA. So I have a lot of clients who have their parents' IRA and have to figure out how to get $2 million out in 10 years, which you're like, oh golly, big problem. But it's just like your parents tried to do the right thing and they tried to save their whole life. And again, they were saving at a 15% tax rate, and now you're about to rip it at 37, and it's just a shame. So
So,
um
but what back to what we need to do before the end of the year. I think the biggest thing for any of these things is going in and making sure that you have established make sure accounts are set up, that you have something in play, even if you're not putting all the money in. You just got to get it in operation before the end of the year. And
yep.
so, last but not least, by any
And
means,
you can walk into a Fidelity office and they'll help you.
yep,
That's the good news about, or I don't, there's a Fidelity office in Houston, Texas. I don't know where you live, but you can also pick up the phone and call Vanguard and they'll help you. Like there are places to get help for this, you know,
yeah.
get help somewhere. Um,
Um, yeah, so just moving into the kind of last section, which is sort of pulling it all together. And I wouldn't say that your books there's a couple things about the books that need to happen before the end of the year, but we just are big believers in steady. I call us like the tortoise of bookkeeping. Like we want to be here, steady wins the race, because if you wait to the last minute, you're sitting here a day, day 350 out of out of the end of the year, then you're really having to make some decisions without having a lot of information.
or you're in October of next year trying to pull all your junk together. Like the shame about bad books, and like we could have started the whole thing off with this, but it's a little too self-serving. We got to wait till the end to really twist the knife, But like ultimately, if you're calling me next August and you're just like, hey, will you fix all of my books and will you get me all caught up? And then will you get me caught up from January to July of this year? And like, we'll do that. We'll charge you for it. But like, you're going to pay like all the money and you're going to get basically none of the benefit because you're just looking in the rearview mirror and you're just doing a bunch of work to file forms with the government. It's a shame where like these books can be a tool to help you make great decisions about your business or have a pulse on your cash flow or be able to understand kind of where your money's going and what your opportunities are. But when you're way behind and you're never looking at them and you're never organized, you don't even know the feeling of like understanding, just being able to pull open and look at your books and be like, that doesn't feel right. What's going on? And go dig in and find some anomaly or spot some opportunity or say, oh, I can tell that we're picking up right here. I can tell that this ad spend campaign's working and we need to go hire ahead because we're about to sell through and have a crazy first half of next year. Like that's an opportunity. That's an asset that you just don't get without decent books.
Yeah, I mean, we do catch up for people. We've been, I would say November, December, January are our busiest months. And, my favorite January customers are those that are coming to me going, "Hey, I want to start 2026 off with a bang." And I'm like, you're doing that's the right answer. But I understand that that's not
Yeah.
always the real answer. And so we pick people up along their life cycle. But I will tell you anecdotally, I hear from so many of our clients who are like, man, I feel so much better. I know what's going on. Man, it's so nice getting a report in my inbox that shows me what's happening with my life. Man, and we look at
Yeah.
our clients as our partners and making sure that all this information is correct. But like, if you don't know what you're doing, then you can't make these decisions. You don't know, you're just basically living in safe harbor land, which is fine. But come April, you can have a real rude awakening. And that's what we've had happen with some of our clients historically, where they're like shocked at how much money they need to pay in tax because they've never looked at their books. They've never seen what their net profit is. They're just like, oh, there's money in the bank. That's cool. Um,
Yeah.
so we also like to make sure people understand what, and I said this at the beginning of the call, we don't pull rabbits out of our hats. We just make sure people understand what are the options for expenses and what we do a home office deduction for like 99% of our clients because they all work from home. It's 2025. Vehicle mileage deduction, uh, just making sure that all these things are being tracked and then of course we're always trying to get people to make sure they're using a business credit card and a business bank account and get everything in one place. But even if they don't, we make sure that those pieces get pulled in because you're just leaving money on the table.
Yeah. If you want to get into like the top 5% in 2026 and get started off right and you do nothing else before the year end, set up a dedicated bank account, a dedicated credit card, and just start running your business like I was your partner, is what I always tell people. Like, run your business like you're accountable to somebody and that you can't just slop in, your kid's haircut and your dog's vet bills, and that you just have to be rigorous about income coming into the bank account, expenses going out of the bank account, expenses going onto the credit card. And there's so many the value we give is not in the bookkeeping. The value that's the foundation of the product, and that's a necessary component to offer uh, programmatic tax advice to people. But I mean, the bookkeeping is going to get uh, sucked into whatever AI and all that. Like that's fine. But like, really, the only way you're even going to get there though is to have these accounts that capture all of your business information, and you're 95% of the way home if you can do that, and then you can start thinking about everything we've talked about on this call. If you call us and like nothing's done, it's hard to even give you advice. Or if you call us and say, hey, I've been running one checking account and my rent goes out of it, my student loan payment goes out of it, and my vet bills go out of it, and income, we can help you, but it's it's a bigger lift.
Yeah, I always say like if you use it all, if we know that your business cards and your business accounts are just for business, we give you the benefit of the doubt. We just count all those expenses as business. The minute you start combining everything, we don't know. We don't know if that electricity bill is for your home or for your office. We don't know if that Costco bill is to go and restock the office cabinet or for your, kids' soccer game. We don't know. So we tend to err on the more conservative side. And so I definitely go back to folks, especially when there's commingling and
Yeah,
there's
but
still clients that I'm going to and saying, hey, remember, that's just your business card. But
when a client comes to us with who's very very rigorous, and then you see something like GameStop on there, you're going like, hey, what happened at GameStop? Is this a business expense? And they could say yes, and I might believe them. So you know
yeah,
what I mean? Like,
it's always a no for Lululemon, but
yeah.
I get that one a lot. And your haircuts, unless it's only like there's no one really, maybe one person I would let haircuts be a business expense. But okay, we're gonna bring it all together because we only have a couple more minutes left. But just as
All
a
right.
where what do you need to do? Here we are, December 11th. So this week, make sure you're reviewing your year-end financials, making sure that if you're talking to your CPA, that you've hit your safe harbor amount. If you need to run a salary, payroll, make sure at least the bare minimum that you are hitting safe harbor, and you could potentially use some W-2 withholdings to pay to the IRS and to your state if applicable, for catching up on some past due quarterlies and things you didn't pay throughout the year. Um, Make sure if you were going to buy some equipment, vehicle, you're running out of time for that, but I know car dealers will sell you a car on December 31st. So to make sure you drive it off the lot. Establish your retirement account if you're going to go down the retirement path, and then um, just make sure you have everything in place. And if you have still time to talk to your accountant, you should. And the next couple weeks, make sure you run any expenses, prepay anything where it's beneficial. Make sure all your document expenses are documented and everything is in place. And then before the end of the year, do any of the employee deferrals, that kind of last paycheck. Be careful with your waiting too late for your last paycheck. I'll just tell you that. Gusto, who pays, they do really great. They have a lot of flexibility, but I think they stop running your last payroll, I think maybe the 26th or 27th. So not too late. Um, and then, come January, be prepared to pay that last quarterly payment on the 15th. And then just if you can get in front of the 2026 year, thank your future self will thank your current self the more of these things you try to get in front of at the beginning of the year.
So, yeah. And, again, well, let's do some commerce. What we probably will take on 5 or so clients before the end of the year. And, but we got to get boogieing. So
We'll
there's a
take on
little QR
anyone in
code.
January. If you want to come in January, let's do it. But end of the year, we're definitely limiting our spots if we want to, be able to celebrate Christmas or whatever holiday.
There's a QR code at the bottom right corner, or you can just go to our website, betterbookkeeping.com. You can click on work with us and go through the flow and get on a phone call with the great Evan Baldridge and get started. And so ultimately, yeah, we're excited to work with you. We're ready to work with you. We work with, again, primarily business owners and oh no, but
What?
small business and self-employed folks who have a few bank accounts, a few credit cards, a straightforward business, and want us to just handle it all. And we've grown a lot this year. It's been a great year, and we have a bunch of happy clients, and I think we're crushing it. What do you think, Evan?
Yeah. Uh, For sure. And our pricing and everything is on our website. So go check it out, betterbookkeeping.com. You can schedule a call with me there. And we, during the kind of consultation sales call, I give you exact pricing for what it is that what you're needing service for. So hopefully, if this makes sense for you guys, reach out and we can work with you. And if you all have questions, can subscribe to Mitchell's newsletter. I think that's where a lot of you guys came from because the content's going to keep coming out and hopefully being helpful and answering your questions throughout, the rest of this year and next. So thanks, everyone.
Thank you.